SIF are like a derivative strategy, okay, where the returns and risk are non-linear. This is the first time SEBI has allowed a shorting in within mutual fund. So another thing about SIF is, instead of sector, themes, equity, debt, what we need to assess is strategies.
Mirae has launched its first SIF.
Which is Platinum SIF by Mirae Asset. What is the core idea for this SIF?
It will have a almost similar upside capture compared to equity savings fund, but much better downside protection.
Markets are evolving, investors are evolving, and today even products are evolving. To know more about this space, I have Gaurik Shah with me. Gaurik, welcome to Funds Ka Funda. Gaurik, everyone, is talking about SIFs right now. While we were having a discussion, we were discussing that SIFs just launched in October, and they've reached an AUM of 12,500 crores, right? So, for an investor, can you explain it in very simple terms? What are SIFs?
Hi Vidhi, first of all, thank you. Thanks for having me here. So SIF are the newest kind of innovation within the mutual fund framework. Uh, they have certain more flexibility compared to your typical long only mutual fund. I think the reason one needs to understand the reason why SIF kind of products was introduced in India by SEBI at this point of time. So, see, derivatives. First of all, derivatives were strategies were never accessible to a normal Indian investor. Initially, when the derivatives were launched in 2001 by NSE, prop guys, hedge funds, institutional clients used to access this kind of strategies. Then, this strategies were made accessible to an ultra HNI kind of clients through AIFs. Now, this is the first time that this kind of strategy is being made available to the mass affluent segment. Still, it is not available to a very retail kind of a client. Now, probably the reason is during after COVID, especially, there were a lot of investors or traders in India who started trading in derivatives and lost a lot of money because and the thought process is that since they did not have any formal way or structured way to access that market, they were accessing through a very unofficial kind of an advisors, fin influencers, where there were very exaggerated kind of claims being made, and people feel cheated about it. So SEBI thought that let's make this kind of strategies available to the mass public, and they will probably go it in a graded way. Currently, they have given some kind of flexibility compared to the normal mutual funds. Where the headline thing is, this is the first time SEBI has allowed a shorting in within mutual fund.
Okay.
In normal mutual fund, you cannot have a naked short positions at all. This is the first time SEBI has allowed. It does not mean full shorting. There is a limit of only 25%.
Yeah.
So one cannot expect a full hedge kind of positions.
Yeah.
Okay. But what it means is it gives more flexibility. Some of the trades which we have been doing in AIFs, hedge funds, prop books, which were not allowed in mutual funds, will now be allowed in SIFs.
Yeah.
So that's, I think, main thing is they have more flexibility compared to mutual fund.
Okay, got it. So, Gaurik, retail investors, or I think any investor for that matter, have one thing in back of their mind, or they'll ask the fund manager or their wealth manager that how much returns will this product give me, right? But investors should also understand that the product has been launched and it's been only 6 to 8 months. So asking for returns or even comparing it with mutual funds is not the right parameter. My next question is that what are the parameters that an investor should evaluate when they are investing in SIFs, and what are those parameters they should think about that if it fits in their portfolio or not?
Okay. See, the thing is, first of all, you are correct that 6 to 8 months is a very short period of time
Yeah.
for any product to be judged,
Yeah.
okay, or evaluated of it being doing correctly, doing it right or wrong.
Hmm.
Okay, 6 to 8 months is a very short period.
Yeah.
And even for that, SIF are like a derivative strategies. Okay, where the returns and risk are non-linear.
Okay.
Some of the risk may not materialize for a long period of time, but they are there,
Yeah. Correct.
right?
Yeah.
So one needs to be aware of that,
Right.
because there are some strategies within derivatives where for a, let's say, 1 year, 2 year, returns may look much more steadier,
Okay.
and risk is hidden.
Right.
That may appear when in certain specific market conditions.
Hmm.
So one needs to be aware of that.
Yeah.
That's why for each SIF, one needs to assess what strategy it is following,
Okay.
what kind of risk it is taking.
Okay.
Having said that, SIF are categorized in 7 different categories according to SEBI. But according to me, ultimately there needs to be 3 buckets. One is going to be conservative bucket, which is going to target around, let's say, arbitrage fund, equity savings fund, short duration funds, funds like that.
Yeah.
Second category will be aggressive fund.
Okay.
They'll be targeting something like BAP plus returns.
Okay.
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 And then third will be your long only SIF funds.
Okay.
So these 3 buckets will be there. Now, conservative funds needs to be assessed within that ecosystem or within those category of funds.
Okay.
You cannot compare a conservative SIF fund with an aggressive SIF fund
Yeah.
or a long only mutual fund.
Got it. Got it.
So that separation needs to be done.
Okay.
And within that also, more importantly, one needs to understand what risk it is taking.
Right.
Because as I said earlier, some of the risk will be hidden for a long period of time.
Yeah.
But risks are there.
Yeah.
And if you want to avoid that risk, there will be cost.
Right.
And the fund which is being conservative, which is being,
Right.
protective of investor,
Yeah.
is bearing that cost. And that fund will look underperforming for that period of time, unless and until that risk materializes, right?
Got it. Yeah.
So it's not straightforward just looking at return
Okay.
and comparing each other
Yeah. Yeah. Yeah.
is a right way to look at it. So
Correct.
that's why this is more complex product than mutual funds.
Understood. Understood. So, like you said, there are 3 buckets for SIFs.
3 buckets should be. There is no official
Yeah, yeah,
bucketing.
but you can
You can
frame it
frame
into
it
3
like 3
buckets.
buckets.
Like, so are there time horizons also for all these 3 buckets?
See, time horizon, I'm more of an asset allocation kind of
Okay.
a believer.
Okay.
So I would say one needs to compare. First of all, as I said, these are going to be more of an asset allocation tools.
Yeah,
So there is
yeah.
specific part of the asset within your portfolio where you
Right.
think there is a gap.
Yeah.
These products will fill that gap.
Yeah.
As I said, conservative products will need to fight against the other
Right.
conservative products.
Right.
Within that also, let's say let's say conservative fund, okay, more or less will underperform arbitrage fund when the markets are falling.
Yeah. Yeah.
More or less they are going to outperform because arbitrage is a very flat return product, and when
Correct.
the markets are down, they are going to underperform.
Yeah. Yeah.
When markets are better, they will outperform
Okay.
arbitrage fund,
Yeah.
and other way around for equity savings fund.
Okay.
Okay,
Got
equity savings fund has a higher participation within when the markets are positive, but
Okay.
when the markets are negative, they also have the same participation. They are going to fall. So
Okay.
typically, conservative SIF fund should outperform equity savings funds when they are falling
Okay.
and underperform when they are
Got it.
rising.
Got it.
But having said that, one thing needs to be understood is these are going to be non-linear return product,
Okay.
ideally.
Okay.
So that's the new flavor we bring it.
Yeah. Yeah. Yeah.
So, for example, our fund, which we have, it will have a almost similar upside capture compared to equity savings fund, but much better downside protection.
Okay.
So typically, let's say equity savings fund had 30-40% participation when the market are rising, and the same amount of participation when the market are falling.
Okay.
So their upside to downside capture ratio is 1 or slightly above 1.
Good.
Well, another case, the upside capture is going to be much higher. Means it will be similar to equity savings fund or slightly lower than equity savings fund.
Okay.
But on the downside, protection will be much higher.
Okay.
So that upside to downside capture would be much higher than 1.
Understood.
It doesn't mean that it's always going to be positive.
Yeah.
When
yeah,
markets are falling, it's going to see some kind of a losses also. It will be curtailed loss.
Correct.
It will be not as high as it will be. Let's say participation could be 5 to 10% broadly,
Right.
but so that's the difference.
So, Gaurik, there's one misconception about SIFs that they are relatively conservative despite of the flexibility a fund manager has, right? Uh, I think it's a misconception. Just maybe, please help our viewers to clarify on this. And are there any such more misconceptions about SIFs?
Sure. So okay, I think first of all there could be a conservative SIF.
Yeah.
Okay, and SIF like mutual fund
Hmm.
will be there across the risk spectrum.
Yeah.
There will be conservative SIF, there will be aggressive SIF,
Yeah.
and there will be long only SIF, which will probably work similar to your long only mutual funds.
Okay.
So there is going to be across the risk spectrum different SIFs.
Yeah.
In terms of misconception, I think one of the misconception initially with the SIF was when the initial SIF concept came in. That time the conception, I mean, general popular belief in the market was that this is going to be more riskier products,
Right.
right?
Right.
Because derivatives is allowed for once,
Yeah.
and derivatives are supposed to be risky product.
Correct.
Everyone has lost money in that.
Right.
So that thing is set in the minds of investors that
Yeah.
derivatives means risk.
Right.
But if you look into it, typically risk in derivatives comes from the leverage,
Correct.
and most of the losses or a main reason of retail investor losing money within derivatives was over leverage they used to take. Within the institutional framework, typically we look at the leverage very carefully.
Right.
Okay.
Right.
So no, it doesn't mean that we do not take the leverage in AF. That leverage is allowed in prop book hedge funds. We can lever,
Yeah. Yeah.
but that leverage should be constrained. It should be thoughtful. It will not be unconstrained.
Correct.
Now coming to SIF, leverage is not allowed at all. Okay, so risk is not going to be higher than your mutual fund, more or less.
Oh.
It also means that returns are also not going to be that super high.
Yeah.
Right.
Correct.
Another misconception was, I think that SIF, since short is allowed, when the markets are falling, it should make money.
Right.
Yes, but we all know in a way that 80 to 90% of any diversified portfolio's returns are connected to the market risk. Okay, so when you say within SIF only 25% short is allowed, so then even consider 25% short, predominantly funds will have a positive market exposure.
Okay.
Okay,
Okay.
then your that fund typically will have 80% of that thing also market exposure. So it's very unlikely that they will be positive when the markets are negative.
Okay.
That is about aggressive SIFs.
Yeah.
There are conservative SIFs like
Yeah.
us, which will have a different set of strategies.
Okay.
Okay, which will have a better protection on the downside, as I said. But that means they would have to give up the upside as well.
Okay. Okay.
In the ideal world scenario, when the markets are falling, I should be short.
Yeah. Yeah.
Okay, I should short 25%, make money when the markets are going down.
Right.
And when the market turn around, then I should go 100% long
Yeah.
and make money that way also.
Yeah.
Okay,
Yeah.
but that's not how the
Yeah. I think
real
that's a
life
very
goes, right?
rosy picture to have.
That's
Yeah.
impossible picture. That
Correct.
doesn't work.
Yeah,
That doesn't
yeah.
happen.
Got it. Got it. So are there any sectors or theme you prefer right now?
Okay, good that you brought this up. Okay, so another thing about SIF is, instead of sector themes, equity, debt, what we need to assess is strategies,
Okay.
right? With derivatives,
Okay.
strategies is more important.
Okay.
Okay, why? Because typically mutual fund, you will be looking at a cash allocation. How much cash has been deployed in equity? How much cash is deployed in debt within equity? How much is large cap, mid cap, small
Yeah,
cap, and
yeah,
things like that,
yeah.
right? Now with derivatives, uh, there is a difference between a cash allocation and a risk allocation. To give you an example, AIF fund AIF Cat C fund, which is doing long short, will typically have 90 to 95% deployed in liquid funds,
Okay.
and only 5-10% will be in the cash in bank balance. So in that way, they're supposed to be very deployed only in the
Right.
liquid fund.
Right.
But on basis of that, they would be taking a futures exposure, options exposure. So their risk exposure is very different,
Got it.
and then cash exposure. Here, similarly in SIFs also, what is important is what kind of strategy one fund is deploying in, rather than looking at sector themes.
Okay.
Kind of strategies will have more explaining power on the risk they are taking.
Got it. Got it. So it's not like a mutual fund where you look for what sectors, what themes. This is more of strategy based product which one should
Yes.
clearly understand,
Yes,
right?
yes.
Yeah. Okay.
Right.
Gaurik, we are now moving to our next segment, which is Funds Ka Funda. The idea is to talk about funds which you manage and, to understand the basic discuss the theme, the strategy behind the fund, and why should an investor, consider to have it in their portfolio, right? Mirae is launching their first SIF, which is Platinum SIF by Mirae Asset, right? Let's start with what is the core idea and what is the strategy for this SIF?
Sure. Thanks.
Yeah.
So, the position of this fund is going to be between arbitrage fund and equity saving fund. We call it arbitrage plus category. That is being evolved in, I think, SIF. That's kind of category which has evolved,
Yeah.
which more or less is basically targeting the conservative side of your risk return curve. See, the thing is, we need to understand the basic difference, first of all. That arbitrage fund is a very flat return product. They will give you certain amount of low returns across the market cycles.
Right.
Equity savings fund is a linear return product, which means they will have a, let's say, typically 30 to 40% market capture when the markets are positive. Similarly, 30 to 40% market capture when the markets are falling. That means if the markets are up 10%, they will be up around 3 to 4%. When markets are down, they will be down 3 to 4%.
Okay.
With our product, we expect to give a better upside capture and a better downside protection.
Okay.
Right? So when the markets are on a positive trend, we probably will give you capture slightly lower than equity savings fund. But when markets are trending downwards, then our protection should be much better than that.
Okay.
Okay. So that's the proportion. Non-linear it is because see, SIF gives you certain flexibility and you should be able to give you some different experience to the investor, right? If you are giving the something similar to what is existing.
Right. So, you just said that strategy, like, we've been discussing a lot on strategy that's the most important aspect what an investor should look at, right? So, for the Platinum SIF by Mirae Asset, what is the strategy you have designed and how are you going to achieve that strategy?
Okay. So there will be 4 building blocks to our fund.
Okay.
First, core strategy is going to be a collar strategy and arbitrage strategy. Okay. So 70% of our deployment will be between collar and arbitrage.
Okay.
Now, why arbitrage comes into the mix? One has to understand the behavior of the collar strategy. Now, collar strategy is a bit complex derivative strategy, but to simplify it, it means that there will be a capped upside and a capped downside.
Okay. Okay.
What it means that if the market goes up till certain point,
Yeah.
there's a participation in the market.
Okay.
But beyond a certain point, we'll have to give out our profits.
Hmm.
Now, that is your covered call strategy.
Okay.
And covered call strategy would mean that your downside is fully unprotected.
Okay.
Right? That's why we'll buy a put on the downside as well. So that is capping your downside. And that's the difference between covered call and collar. And we are following collar strategy, not covered call.
Okay.
That's why we are very confident of providing that downside protection to the
Yeah.
investors.
Okay.
But when we say that we are capping the downside, that means there's still a downside. So when markets are falling, till the point where we have bought our protection, investor or fund will see some losses.
Okay.
Right?
Okay.
So that is the nature of collar strategy.
Yeah.
That they will participate till certain point.
Okay.
That means when the markets are falling, there could be certain losses to the fund.
Okay.
It will be a capped loss, but
Yeah.
still will be there.
Okay.
So, to reduce the volatility in because of the nature of the strategy, we bring in the arbitrage.
Okay.
So, arbitrage is for us like a cash call,
Okay.
right? When we think markets are falling down, we move more towards arbitrage.
Okay.
So, allocation between collar strategy and arbitrage strategy is going to be more flexible based on the market conditions. When the market conditions are good, markets are trending upwards,
Okay.
we have more allocations to the collar strategy. And when markets are trending downwards, then we have more allocation to the arbitrage strategy.
Okay.
It's not 0-1 game.
Yeah.
It's not a binary call by us,
Yeah.
but it's going to be more graded approach,
Okay.
more I would say, because what happens is if you start taking binary calls, then you can go completely wrong.
Okay.
In March,
Yeah.
you would have gone completely short and gone more on the completely on arbitrage, and then April happens where you miss out completely on the upside.
Right.
So you cannot have that kind of 0-1 calls.
Got it.
Okay, in these
Okay.
markets, that is important. Now, third part of the strategy is going to be the special situation.
Okay.
That is kind of a return enhancer for us.
Okay.
If there are any trades which are available in the market which can give us a better returns compared to our arbitrage or collar strategy, we will take it. There could be varied kind of trades. Some examples are merger demerger trades, or there could be an buyback trade, open offer trade. That could be an IPO we could apply. In IPO, we will not be applying for the probably anchored,
Yeah.
because they have more blocking.
Okay.
We would probably go for listing gains. Then there's a debt part of it. And that would be split between our core portfolio, which will be more accrual based, high quality credit strategy, and there would be a liquidity portfolio which will be more into traps, T-bills, things like that.
So, if an investor is considering to invest in the Platinum SIF, how should they decide whether it's suitable or not suitable for them?
See, first of all, I think our market is more evolved now.
Yeah.
So earlier the question was, this particular product is good for this investor, or more suitable for this investor who is more conservative, and there is other product which is more suitable for other investor which is more aggressive. Now I think most of the investors have allocation across the risk spectrum.
Yeah.
Some will be, who is more aggressive will have more allocation towards the aggressive side of the portfolio, but he will still have that conservative side of the portfolio, right?
Yeah.
Someone who is conservative will have more allocation to the conservative side, but he will still have some allocation to the aggressive side of the portfolio.
Yeah. Yeah.
So in that sense, this I think fits perfectly on the conservative side of the portfolio,
Okay.
because it has distinct advantage compared to all of the products available currently. With some product, it could be better alpha. With some product, it could be better protection.
Okay.
Right?
Yeah.
And that's why I think this product is suitable for all the investors
Okay.
and to be part of the conservative side of the portfolio.
So, Gaurik, last question. Platinum SIF by Mirae Asset. How would you differentiate our fund with the other funds available in the market?
See, I think this is a product which I think is a very good product for the conservative side of the portfolio.
Okay.
Now the time Indian investors evolved, where there is no conservative portfolio, conservative investor or an aggressive investor. Okay. In the sense that most of the investors have allocation across the risk spectrum. Okay. Even the aggressive investor will have some allocation to the conservative side of the portfolio, and the conservative investor will have some allocation to the aggressive side of the portfolio. This product fits perfectly on the conservative side portfolio, which has a distinct advantage over all the currently available products. Okay. With some product, it could be in terms of alpha. With some products, it could be in terms of better downside protection. Okay. It brings non-linear return and non-linear risk on the table, which is currently not available in your mutual fund scheme of things.
Okay. Gaurik, thank you so much. It was a wonderful conversation with you. Thank you so much.
Thanks a lot.
Yeah.
Thanks a lot.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.